The proactive tax planning work before you prepare your tax return can save you thousands of dollars in taxes, either right now or out there in the future. Have a real life planning scenario, that more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Tax planning, there's no deadline. It's not required like tax preparation is. However, tax planning is that proactive, creative work for you to reduce the amount of taxes that you pay either in this present year or really how we like to measure is over your lifetime, if not multiple lifetimes. And yet, many people, because it's not required, they focus just on tax preparation and never do that creative work, never actually see if there's any opportunities that they're missing out on. And guys, that can cost thousands of dollars. One small example to illustrate, this one came across my desk recently, and it's a great example of folks where they've unfortunately missed out on some tax planning opportunities over the past couple of years. Here's the scenario. It's a young couple in their early 30s, and both work, so two-income household. However, the primary breadwinner and then part-time secondary income. So primary breadwinner makes about 90 grand a year, and then spouse works part-time, making about 15 grand. So decent income here in the Midwest, but they've got three small kids, and I mean young kids, all three 6 and younger. And so very busy household. I'm assuming that's probably contributing to primary breadwinner and then just part-time income. But so gross income, about $105,000. If you subtract out some of their pre-tax stuff and then the standard deduction, they pay tax on 70 grand. As married filing jointly, okay, the first 23,000 and change of that is at 10%. And then from that 23,000 up to over 90, but in their case, up to 70,000, okay, is taxed at 12%. That's how their taxes work. When you do the math, that tax is somewhere between 7 and 8 grand of the actual tax that they were responsible for. But that's before credits. That's before credits. And I mentioned they've got 3 young kiddos, and each of those kids represents a $2,000 child tax credit. Deductions are good. Deductions reduce your income. Like I said, the standard deduction brought their income from 105 down to about 70 grand where they actually paid tax. They had some other, I'm rounding there, they had some other deductions as well. But then credits are great. Credits are dollar for dollar reductions in your tax bill. And so let's just say that their tax bill was $7,500. Take 2 grand off for child number 1, take another 2 grand off for child number 2, take another 2 grand off for child number 3. That $6,000 of child tax credits reduces their $7,500 tax bill down to $1,500. And what makes matters even better for them is because they both spouses work, they had some child care expenses for the couple days. I'm assuming one of the spouses worked, and they got some child independent care credits as well. The actual tax that they paid was around $1,000. Had a lot more than that withheld for taxes. They got a big refund. And I'm assuming you're thinking, if you're in their shoes, 3 young kids, a big refund, that probably was very beneficial. So what's the bad news? Where's the missed opportunity? Well, I mentioned a couple times that they have some other deductions. They're both contributing to their 401k through work. That's fantastic, right? They're each contributing about 8%. And on $105,000 of gross income, it's about 8 grand going to their long-term and their retirement. That's fantastic. I would coach them and want them to be contributing closer to 15%, but I get it. And especially with 3 young kids, finances are tight, I'm sure. But they're contributing to their 401k pre-tax. They are getting the tax deduction on that, let's just call it 8 grand that they're contributing towards retirement. That is reducing their income. That is then kind of reducing their tax. Here's the problem. They make $105,000 a year and they're paying less than $1,000 of taxes. That is fantastic. But the deal that you make when you're contributing pre-tax is that, okay, give me the deduction now, I'll pay the tax on this later. Well, the later is likely in retirement, not when they have these child tax credits at home, and therefore they're likely getting a deduction today when they're barely paying any taxes and are going to have to pay tax on that money out there in the future at a higher tax rate. Now you might be thinking, why are they doing this? How is it possible they're basically not paying any federal taxes and yet they're contributing pre-tax to their 401k? First, they may not know their tax situation. This is the first time they've come to us and said, hey, will you prepare our return? We need someone that can help us with our tax preparation. They might not know. They might also not know that that's really how their taxes work, that's how credits work and deductions work. They might not realize. They might just be thinking, yeah, we have a 6-figure household income, we're probably paying a decent amount of tax, and yeah, these kids help us get a refund, but they might not know all the ins and outs. Taxes are confusing. So that could be the first. They don't know. Second, they might have been auto-enrolled into their 401k. Auto enrollment into the 401k, there's a big emphasis towards that, and that feature being on plans. And on one side, yeah, that's a good thing, and it has good intentions. But on the other side, I can't stand it. I can't stand it. It puts some of the most important financial decisions that you could make in your life, puts them on autopilot. And so if you should be contributing to the Roth side of your 401k instead of pre-tax, auto-enroll is pre-tax, right? So that's the second idea, or second reason this could be happening. And the final is, it's possible both of their 401ks only have a pre-tax option and do not have a Roth option. I think that's unlikely because over 90% of 401ks out there now have a Roth side of the 401k that you can use. But even if you didn't have the Roth 401k available to you, if you're in this situation where you essentially have enough tax credits to wipe out all of the tax you pay and you're still saving for retirement, thank you, you should be. Contribute just enough to your 401k to get the match and then contribute everything else to the Roth IRA. A better option is, and you can see that I'm sort of hinting to it right now, still be to contribute towards retirement, right? It's not to say, hey, you don't really have any taxes due, so therefore don't save up. No, absolutely still save up, especially you're in a very, very, very low tax situation, and therefore pay the tax today. Contribute to the Roth today, because with the Roth, you're not getting a tax deduction today, and yet you're still investing in the same funds, and the investment performance experience is going to be the same way, and it's going to be sheltered. But then when you withdraw those dollars, again, I mentioned they're in their early 30s, when you withdraw those dollars out there in retirement, all of that growth comes out tax-free. And so basically the decision between pre-tax or Roth is, what tax bracket are you in today? And what tax bracket do you expect to be out there in the future? If you are in a low tax bracket today, you don't want the deduction, and that's exactly what this scenario is in this instance, because they've got these child tax credits. This is just one of the countless examples where it makes sense to be doing proactive tax planning. Basically shine the spotlight on, hey, are there any missed opportunities here? Is there a way for me to restructure what I'm doing to pay the least amount of tax over my lifetime, if not multiple lifetimes? So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.